Even though I'm a CPA, I'm not going to bore you with a bunch of accounting mumbo-jumbo, a bunch of tax regulations. I know that you're dealers, and I know what you do, and I understand that. So you've got my word, and I'm going to make sure that over the next 45 minutes, you come away with something that's going to save you some money on taxes. So let's get started. Yesterday, I moderated a panel on the tax law changes from 2017 and what effects those had on your 18 tax returns. And the first thing is, many of the tax returns haven't been filed yet because we're still trying to find out the rules that they passed in 2017. So there's a lot of time needed to understand how to apply the tax law changes that occurred in 17. And the more time we have, the better we're going to get at it. But one thing that hasn't changed is related finance companies. Now, the first thing I want to do is I want to get on the same page with you. So we're going to start by talking about what are the benefits of a related finance company. As part of the Tax Act of 2017, they liberalized the use of the cash method of accounting. So maybe when you go back, your accountant said, hey, I think you can use the cash method of accounting now. You don't have to, you don't have to report on the accrual basis. We're going to talk about that. So do you have a choice? Can you choose between having a related finance company and the cash method of accounting? We're going to talk about that. Maybe you're already on the cash method of accounting. Maybe you're already using it. So I'm going to talk about that, what you do if you're on the cash method of accounting and whether or not that's going to be a problem. Then I'm going to talk about lender considerations. Everybody needs capital in this business. So how do your lenders feel about how you structure the deal? And then helping you make the right choice, the one that's going to be best for you, and then I'm going to take any questions. So that's what we're going to cover in the next 45 minutes. And again, it's not going to be a lot of tax code stuff. We're going to start with this. You see this line? Maybe this looks like yours. See this front line? Look at that front line. Boy, every car's detailed. Looks great, doesn't it? First class. Yeah, wouldn't everybody like to have a lot like that? Just the right size. And that's probably what your lot looks like when you get back there. And that's the way it all starts. And the consumer comes in and picks that car out of the front row and gives you that installment contract, and boy, this is going to be great. It's going to be all money. The problem is it comes back looking like this. And I think we've all had this experience where when they default, they just tear the heck out of the car. And, all of a sudden, instead of having all that profit that you thought you were going to get, now you've got this big loss, and you're wondering where all the cash went. So we call this the tax on phantom income, because the IRS thinks that without applying the right tax strategy, that when you sold them that car, when it looked like I just showed you, that was all profit, even though you took a big installment contract, and so you should pay tax on all that. Well, where's the cash going to come from when it comes back looking like this? So that's the problem. That's the problem that we're trying to solve, is how do you match the cash flow with, the tax deductions and pay a reasonable amount of tax. So that's what we're trying to accomplish. So let's go through a very simple example that's going to show you the difference between paper profit and cash flow. Using the benchmarks that I created, that I hope all of you got at this show, we take an example where you sell a vehicle for $12,000. I made it simple. Ignore sales tax and all the other stuff that may go along with it, add-ons. You sell a vehicle for $12,000. You get $1,000 down, and you get an $11,000 installment contract. So, and maybe it's over 36 months, 40 months, whatever it is, 43 months if you're following the benchmark. So this is an exact example right out of the averages out of the benchmarks for 2018. I didn't make this up. This came right out of there. So, the IRS is saying that you sold it for $12,000, and let's say the cost of the vehicle, again, using the benchmarks, was $7,000. Say you had $7,000 in it. The IRS says, hey, you just had a $5,000 taxable profit. You just had a $5,000 taxable profit. Well, I don't know about you, but I don't think that $5,000 profit that check's been cashed yet, because you've still got $11,000 that the guy owes you, and we saw what that looks like sometimes. So let's go over the cash flow side. Let's look at the cash flow side of it. We gave you that $1,000 down, and oh, by the way, ignored sales tax and all the other front end costs that you've got. So you really didn't get $1,000, but I made it simple here. You got $1,000 down from the guy. Hey, great, we started off with $1,000. Oh, wait a minute. I just paid $7,000 for that vehicle and reconditioned it. So I've got negative cash flow of $6,000 at that point. So you're out of pocket by $6,000. So here's our problem. The IRS said you had a $5,000 profit, and you just had a $6,000 negative cash flow impact. So you see the problem that there's no cash there to be able to pay tax on that $5,000. And I've tried to tell the IRS that many times. I wrote a position paper along with NIADA. We tried to get them to change their thinking on it, and they said, oh no, if we did it for you, we'd have to do it for everybody, and we're not going to do that. So those were the rules that were in place. Now, let's talk about why, and I pioneered the related finance company strategy over 20 years ago. I was the first CPA in the nation to ever get the IRS to sign off it. I've written 3 audit guides for the IRS, including one I'll show you. So, and I've done over 500 of them nationally. I've done over 500 of these. I've never had one collapsed, never had a problem on any of them, even ones I didn't create. So what I'm telling you is absolutely true. It's based on working with the IRS. So let's go back to that example. There was that $11,000 installment contract that I talked about, but this time you're going to sell that contract to your own finance company. You're going to just transfer the contract over to your own finance company. It can have exactly the same ownership as the dealership. Exactly the same. You don't have to have any different ownership at all. But this time, we're going to sell it at a discount. We're going to sell it for 60%, because we know that in the buy here, pay here business, because of defaults and other things that go along with it, a contract's not worth face value. So we're going to sell it for 60% of the value of the contract, or $6,600. So now that $11,000 contract has generated a $6,600 tax deduction for you, because you get to deduct that discount. So going back to the prior example, instead of having a $5,000 profit that the IRS said you had with no cash, now you get to deduct $4,400 for the sale of that contract to your own finance company, so you still own it, and you still have an $11,000 contract. And so now all you have is a taxable profit of $600. That's all you have. And that's just one example. So now let's look at the next slide. What did we just do? We turned a $5,000 taxable profit into a $600 taxable profit. That's an 88% reduction. 88% reduction in the taxable profit that you're going to have to report in your tax return. Now, that's one deal. Multiply that times 10, 20. If you're selling 100 a month, 200 a month, whatever volume you're doing, it just multiplies. It multiplies. So I'm telling you, if you don't have a related finance company and you're paying taxes because you think paying the government will keep them away, it's just the opposite. The more you pay them, the more they want. They're not going to buy a vehicle from you, and you don't have the cash to pay the tax. That's the classic problem. So that's why we created related finance companies. And so I've given you a basic example. Now, I said I go back a long way. Chapter 11 of the IRS Automotive Audit Guide was written by me and the AICPA. I wrote most of the Chapter 11. It's perfectly legal. This is what it says. The use of related finance companies is a common practice in the used car industry. Such companies serve many valid business purposes and were utilized long before any tax advantages. There are several valid business purposes for establishing an RFC. An effective RFC removes the collection burden from the dealership, allowing personnel to operate their dealership. It's perfectly legal. It's perfectly legal. So if you go back and your accountant says, oh, I don't know, as soon as you do that, you're going to get audited, he doesn't know. He or she does not know. It is perfectly legal. All of the major players in this industry have a related finance company, because I've set up or restructured most of them. So the reality is you don't have to worry that it's voodoo, that it's going to be a tax problem for you. It is a valid situation. So let's talk about the tax problem that you're facing. We showed you the tax on phantom income, and I'll go into that a little bit more. But the problem that we have is that under the old tax laws, because you have inventory, and you're selling vehicles, the IRS said you cannot use, this is prior to the Tax Act change, you can't use the cash method of accounting. Because if inventory is significant in your business, and it is in a car dealership, you have to use the accrual method of accounting. So let me translate that for you. That's the example that I showed you earlier, where you have an $11,000 receivable. You haven't collected the cash yet. You're out of pocket $6,000. That's what they say you have to use under the old rules. Now, the problem with that, if you're a car dealer, is the following. First of all, you got to pay the tax before you collect the money. So where are you going to get the cash from? Number two is when it comes back in defaults or you have a repo, you didn't have the profit at all. Now you got a write-off. And you say, well, wait a minute, I get the write-off then. Yeah, but that may be 2 years after you had to pay the tax. So you're out of pocket. No wonder you have to borrow so much money. I mean, the reality is that you're prepaying everything. So that's not a good answer. That you can ultimately get a tax deduction for it. Nobody in this room would want to pay a tax today for the possibility of getting a deduction 2 or 3 years down the road. What about a skip? What if you don't even get the car back? That shell I showed you, what if you didn't even get that back? Well, when do you write it off? And if you do, will you get audited and somebody say, hey, you've been too aggressive, you wrote that off too fast. So a lot of times what we see is people, when they're not using all the right tax strategy, they're too aggressive. They start deducting everything under the sun. They over-deduct things, then they get audited and they have a bigger problem. So I say to you, your risk is not using all the rules in your favor, not being knowledgeable or having a professional work with you to help you reduce your taxes. And the problem is that the more volume you do, the worse the problem gets. So a lot of times when people come to me and say, you know, I'm thinking about starting a related finance company, I said, no problem, and I give them the information, and they say, well, we're thinking about it. And usually within 6 months to a year, they all call me up and say, we're ready to go. Because you just can't outrun the thing. You cannot outrun it. It gets worse and worse, the more volume you do. The negative cash flow impact of paying taxes before you're collecting from the customer is economically unsustainable for you as a dealer. So you've got to find ways to match the income with your cash flow. And so the solution to this is creating a related finance company. There was some confusion yesterday. You have to have 2 corporations. Now, let me explain. If your dealership is a corporation, when you set up your related finance company, you have to have it as a corporation. Now, someone said, well, does that mean you can't use an LLC? And the answer is you can use an LLC, but when you set up a limited liability company, you have to make a tax election to whether or not it's taxed as a partnership or as a corporation. And you want it taxed as a corporation, a subchapter S corporation. So your dealership can be a C corporation, and your related finance company can be an S corporation. You could have 2 C corporations. You could have 2 S corporations, but they have to be a corporation. And the reason is that the tax exemption that I'm going to show you is under the related party corporation rules. So the IRS have been very rigid in saying, look, you can do this, but it has to be between 2 corporations. So if you're a partnership or proprietorship, or you're elected to be taxed as a partnership, you can't use one of those entities as part of selling or purchasing those contracts. So, that's just one of the technicalities of doing it right. So as we move through these, and I'm not going to go through all the tax sites, these are all the tax sites. And by the way, I'll be happy to give anybody a copy of this presentation afterwards. And if you go back and your accountant says, or your tax advisor says, wait a minute, I don't see where it says you can do that. Well, we'll give him the slides and give him all the tax sites, and he can go look at them and find out just what I'm telling you, that it's all perfectly legal. So where is the ability to sell contracts, and how did that come about? Well, it came about because there's a secondary market for all these contracts. We know that in the exhibit hall, there was a bunch of note buyers in the exhibit hall. Whether you sell your contracts or not, we know there's a secondary market for it. So my argument with the IRS years ago was there's a secondary market if we have our own finance company and sell it on commercially reasonable terms. Why can't we get the same tax benefit that they get? And that's what the Treasury ultimately signed off on that. They said there is a secondary market, and as long as you're selling the contracts at arm's length for commercially reasonable terms, then you can get an exemption from the related party rules, which would otherwise disallow the ability to sell it to yourself and get a tax deduction. So they carved out an exemption at 267-F-1F. You don't have to remember that, but that is the basis by which you can use a related finance company. So as I said, you have to sell it on commercially reasonable terms. You have to pay for it. So you can't just make a journal entry saying, hey, here's this contract that I just created in my dealership. I'm going to transfer it over to my finance company on paper. And then when you file the tax returns, you take the deduction, you have to pay for it. So the typical structure is that you get a line of credit coming into the related finance company. You send the contracts over. It's financed by the line of credit. The cash goes over to your dealership. You take that cash, you buy another vehicle, you turn it into a contract, and the wheel keeps turning. So some dealers have said to me over the years, oh, Ken, wait a minute, I don't know if this is going to work. I need more cash over there. Well, the amount of cash is exactly the same with a related finance company or without one, with one exception. You didn't write the check to the IRS. So the savings is going to help actually give you more cash flow, but the amount of cash flow that's turning through the system is going to be exactly the same. But it takes some planning to make sure that you're pricing the transaction properly so that you do have enough cash flow over in the dealership. And that's where experience with working with these things really makes a difference. Is usually what I see is when there's not enough cash, it's because the overhead isn't structured properly. They're not selling it at the right price. They're not paying for it. But it does absolutely work if you structure it properly. So in the audit guide that I helped write and create, there's a 26-point checklist of the things that you have to do to be compliant when you set up an RFC. And I have, RJ's got, hold on, RJ, I've got copies in the back, and at the end we'll give all those to you. There's no secret about what you have to do. I'm giving it to you. So you say, well, geez, if I've got all the answers here, it sounds easy. Well, there's some assembly required. But the reality is that I want you to know what's involved, And not all of those things are created equal, but I don't want you to go back and know that you just can do whatever you want and get this big deduction. This is the biggest tax deduction in your return. This will be the biggest tax deduction in your return. But you have to be compliant. So if you don't get one today, you can call me or email me and I'll send it to you. Happy to give it to you. All right, so what are the benefits? It defers the profit and interest over the life of the contracts. It's not tax avoidance. You have the ability to charge off skips and repossessions as they occur and deduct them against your taxable income. That's the matching we've been looking for. We have the ability to retain quality notes because instead of having to sell your contracts because you need enough cash to pay all the tax that the IRS said you had that you never collected, now you can retain those contracts instead of having to sell them off and preserve that cash flow and hopefully not having to, to liquidate some of your paper that you might otherwise have to do from paying the taxes. The separation of the related finance company from your dealership is a good thing from a liability standpoint. I don't have to tell you there's risk and liability in operating a dealership. There's all kinds of things that can happen. And if all of your contracts are in your dealership and you get sued, you put them all at risk. So separation of the contracts into a separate entity is a good thing from a legal perspective. Also, how do your lenders look at it? How do they look at it? They like RFCs. They don't want you to overpay your taxes. They like the separation of having their collateral in a separate entity, so they look upon it favorably. And there is some reporting challenges, and we can talk about those, but generally it's a very positively received by the lenders, and they'll tell you that. So don't think that they don't like it. And there are estate planning opportunities. There's ability to transfer value from your portfolio into key employees or to key people, to family members, and do it at a substantial discount. And I can show you how to do that, and it's very important. Although the estate exemption has been increased now to $12.5 million if you're per individual, and so it's not as much of a problem. That's not permanent. That can change in the future. So you've got to be thinking about the long term, and as you're building value in your portfolio, you want to be able to retain and keep that, and you can do that with the RFC. So I mentioned earlier, cash accounting has been around for a long time, and the IRS initially made a change a few years ago to say that, if you had less than $1 million or less in gross receipts, you can use the cash method of accounting. So smaller dealers would call me up and say, "Oh, thank God, Ken, I don't know if you had anything to do with it, but even if you didn't, we're going to be on the cash basis of accounting." Not so fast. Not so fast, because the problem was that the IRS did make that change, but they said, "Oh no, if you've got inventory, you can't use the cash method of accounting, even if you're under $1 million in a smaller dealer." So, if you're a buy here, pay here dealer, and you're holding installment receivables, you couldn't use the cash method under it being less than $1 million, even if you're a small dealer, because you had inventory and you're required to use the accrual method of accounting. So along comes the Tax Cut and Jobs Act in 2017. And the thing in the 11th hour, they pass a change in the cash method of accounting, and they said, now if you have less than $25 million or less in cash receipts, you can use the cash method of accounting. Hooray, finally we got it. And, oh, by the way, that problem we had when we had, the smaller $1 million limitation, we're going to eliminate that too. We're not going to restrain you from using the cash method if you've got inventory. So on the surface, everything looked great. And people were getting ready to go say, this looks just like what we needed. We're going to go to the cash method of accounting. Unfortunately, 6 months later, the interpretations came out. And what came out is RevProc 2018 2018-40, which provided the details of how to change to the cash method of accounting. So we needed that guidance. You know, first of all, what's required, what forms do you have to use, approval, do you have to get approval to change accounting methods? There were a lot of details that we needed the answers on. So 2018-40 was good because it told us what to do and how to do it, and they did make the change to the cash method automatic. And what that means is you don't have to get IRS approval. You file a 3115 and it's automatically approved. So it's not like they have to look at the impact of it or see if, if it's how much it's going to benefit you and try to figure out how to cheat you out of it. They actually said it's an automatic change, and there's benefits associated with an automatic change, which I'll talk about in a minute. Unfortunately, with RevProc 2018-40, there was one small detail, and that is they defined receivables that could be treated on the cash method of accounting, and they said that open accounts receivable are only those which are due in full in 120 days or less. Those are what we call cash equivalents. And so if you're dealing with an installment receivable as a buy here, pay here dealer, you're probably got a term longer than 120 days. I feel certain of that. So unfortunately, those receivables don't qualify, and therefore you have to continue to be on the accrual method of accounting. But if you're doing retail, and you've got contracts in progress and you're not doing buy here, pay here, this opportunity is available to you because your contracts in progress or contracts in transit, so to speak, as you call them, would generally qualify because they're within 120 days. So you could use the cash method of accounting. So there is some relief here with the cash method of accounting. It's just not going to help those people that have buy here, pay here receivables, where the biggest benefit is, because the receivables are not cash equivalents as they defined it. So unfortunately, the buy here, pay here dealers can't get the maximum benefit. So what's the conclusion is that although it initially appeared that we were all going to benefit if you were under 25 million in gross receipts, it turned out not to be the case. But some of you, if you're doing retail or you don't have an installment portfolio, you're not keeping the contracts, you're selling them off, you may be able, to benefit by using the cash method of accounting. There's some other considerations which I'm going to go through. Now, for those of you who want to do that, I should tell you that under the RevProc 2018-40, the automatic change provisions, you can automatically change. You get to spread the impact of whatever that change is. If it increases your tax, you get to spread it over 4 years. So that's better than anything you can add. Oh, and by the way, there's audit protection, meaning that if you were using an unacceptable method and you use the automatic change provisions that they provide under Form 3115, you get to spread the tax impact over 4 years, which is good. And secondly, they can't audit you on it. So that's good too. So if you've been doing it wrong and you do qualify to make the change, I advise you to go ahead and make it. And here's why. You're going to shoot yourself with your own bullets, because when you file your tax return, it asks you what method you're using. If you're a car dealer and you've got receivables and you check the cash method of accounting, it's just like putting a sticky note on the front of the return and say, why don't you come in and audit me? So the reality is you're not hiding anything from them, but now is the time that if you can use the cash method, you could convert over and get audit protection. Now they can't come after you. So the reality is, think about that and decide whether or not you might qualify for the cash method accounting. So do you have a choice? Well, yes, you do have a choice, but no, if you're a buy here, pay here dealer and you got receivables in your portfolio that are longer than 120 days and you're holding them, you don't have a choice. Your only choice, you've got two choices. You can overpay your taxes, and if you do, God bless you, somebody's got to pay all those taxes. I don't want to do it. So if you want to overpay your taxes, go right ahead. But if you want to use the benefit available to you from a related finance company, that's the way the bigger guys in the industry are doing it to shelter that income. So the bad news is the installment receivables for buy here, pay here dealers don't qualify, but the good news is that if you can use the cash method of accounting, you get the benefit of the automatic change provisions that I talked about earlier. And so there is a decision that you have to make depending on your business model. Lender considerations, and before you change to the cash method of accounting, before you do, if you have a lender, I encourage you to make sure you communicate with them. You know, typically lenders don't want you making a bunch of accounting changes without some discussion. So, or if you're thinking about going into the capital markets and you've been reporting differently and now you're going to change, that may make it more difficult for you to get the capital that you need. They do prefer the receivables to be on your balance sheet. So if you're a buy here, pay here dealer and you've got receivables, they like to see those on your balance sheet. There is a new credit loss measurement standard, which was talked about today. I've been talking to the top people at the AICPA, and it looks like there may be a deferral of time to implement that. But you should go back and make sure you start working and figuring out what the impact's going to be on your business from implementing that new tax law strategy. I'm not going to talk about that today, but if anybody wants to call and talk about that, I'm happy to do it. It's worse to be overly aggressive in filing your taxes to get a decent tax answer. Use the rules that are available to you. Don't get overly aggressive because that'll come back to haunt you. You should have conformity between your financial and your tax accounting. There are some book and tax differences. Typically, when you have a related finance company and you're filing reports with your banks or you're trying to compare them with the benchmarks, you combine the two. You consolidate the two, just as though the related finance company didn't exist. That way you can compare with people who do or don't have or are using a different discount than you are. So it's easy to understand even when you have a related finance company if you report it properly. Capital providers don't want you to overpay your taxes, so they understand why you're trying to get a tax savings. I talked earlier, there's estate planning benefits. But I encourage you to sit down with your tax advisor and talk with them about what's the right decision for you. The cash method is unacceptable, as we talked about, for buy here, pay here dealers. It would produce a contingent tax liability if you did it anyway. And RFC can offer numerous benefits that I've mentioned, so that is an acceptable strategy. You don't have to do either. Again, it's your choice. If you feel writing a big check to the IRS every year is the way you want to go, as I say, that's your decision. Now, when you go back, you may have a great CPA, and he may have been with you for a number of years, but he may not be familiar with this strategy. And if that's the case, you don't have to change CPAs. You don't have to criticize him for not being up in this area. There's really only, 5 or 6 of us around the country that are really specialized. I'm probably one of the few that have actually, done as much in this space as I have. But I wanted to share that knowledge with my profession and with all of you. So I created an audio-video product. It's right here. And I sell this. You don't have to, I don't practice anymore, so you won't use me as a CPA, but I will consult with them to make sure they do it right. And as I say, we've never had a problem, but you have to understand what the rules are, and you have to apply it properly. And I'm going to ask RJ, for anyone who likes it, I've created a handout of the 10 biggest mistakes that people make when they start a related finance company, the thing that does give them a problem, and I'm going to give those to you so you know what to avoid. I'm going to tell you where the problems are. RJ, if you'll hand those out, if we run out, you can just email me or call me, and I'll be glad to send you a copy. There's no secrets that if you do it wrong, it can be a problem. So RJ's handing those out. So right now we've got about 15 more minutes, and I'd like to take any questions that you may have. And just by show of hands, now that I've gone through all this, how many of you already have a related finance company? Wonderful. That's great. Very good. And how many of you set it up and haven't ever looked at the rules again after you set it up, or maybe you didn't look at it the first time, but kind of forgot about it. You're using it, but you haven't really gone back and looked under the hood anymore. Is that fair? Is that fair? It's not something you think about when you file a tax return every year, but do you look at whether your related finance company is meeting all the rules or not? And what I want to tell you is that we'll give you the 26-point checklist, and my point is this, that when you file your tax return, have your accountant take the checklist that I'm going to hand out today and make sure that you're doing all those things. Because then you're being proactive rather than waiting for an auditor to come in and say, hey, you didn't do it right. It's legal to do it, but you made a mistake. So, I don't want any of you to have a problem, and I'd rather have you see you do it right, and the rules are very clear. You just need to follow it. And so your CPA, as he's doing your tax return, can take the checklist and tell you whether you're compliant or not. So you don't have to worry about it. So, RJ, you're going to hand those out as well? Okay, the 26-point checklist. Okay. Then I think the other thing is some of you have not started a related finance company. So in Texas, the technical term for that is you're fixing to do it. You're fixing to do it. So I'm going to be technical with you now. Why are you still fixing to do it? What is it that's concerning you? So tell me, and I'll try to help you make the right decision. Is there anybody who hasn't done it just because they think it's too risky, they're going to get audited, or you're going to go to jail as soon as you set it up, that it's a scam? Is that a concern? Or what are the concerns that you have about a related finance company? Tell me. Tell me.
Actually, a leasing dealer the last 7 years. So with the leasing company, I didn't need to have that RFC. At least I wasn't large enough that the losses didn't, because I could do it on a cash. The leasing company.
Well, thank you.
I had a related finance company from 2008 to 2010.
Yeah.
And I actually used your kit and set it up that way.
Yeah.
And I got audited in 2009, and I went through with flying colors.
Thank
So
you.
I could be your poster child.
Well, one of the most gratifying things is 3 people have come up to me during this conference, shook my hand, and said the exact same thing that you just did. They said, you set us up on the right path. Thank you. And that's what I'm trying to do with all of you. I mean, the reality is that it's no fun not to have any cash flow or to give it all to the IRS. It just doesn't work. This is a capital-intensive business, so you have to use the rules in your favor. Now, and Charles, I'll get to you in just a second. Let me give you some guidelines. At what point should you set up an RFC if you don't have one? Well, the answer is generally if your portfolio is $500,000 or less in receivable balance, if it's $500,000 or less, a good CPA who knows the business can create enough tax deductions for you without an RFC to shelter that income. But if you get to $500,000 and you're growing, that's when there's not enough deductions available to you unless you use an RFC. So I get the question all the time, at what size should you do it? I recommend you do it at the beginning because you're not in the buy your pay your business, not to try to grow your business or grow your portfolio. So I would encourage you to look at right from the beginning, but 500,000 seems to be the threshold. So Charles, go ahead, sir.
Yeah. When you get into that is a big deal. I can
Yeah.
tell you that right now. I got a couple of questions, Ken.
Yeah.
I'm getting
Thank you,
back-
Charles.
I'm fixing to get back into the business.
Okay, good. We need you back.
You heard that fixing now.
We need you back.
But in the startup situation, can you use a little bit of the AP and AR between the related companies to, rather than 100%, writing 100% of the check for the discount amount, or can you actually use the AP and AR side of things to?
Good question. Good question. And let me translate, I think, to maybe what I think I hear you saying. The question is, in the example that I gave where you sold that $11,000 contract, I think the question you're asking is, if you bought it for $6,600 in my example, do you have to pay all that cash at one time? And the answer is no, you do not. And the reason is that when you are selling contracts in the commercial market, there's always some holdback. There's always some holdback. And usually it's maybe 20% of the purchase price, or they set up some kind of reserve for a period of time. And so it is possible to structure it where, yes, you have to pay maybe 75 or 80% of the purchase price, but then you have more time to get the other 20% in, Charles, to go ahead and pay it. Now, what you can't do, and there's case law for this, is that you can't you can't just transfer the contract over for no payment and use the cash flow that's going to be coming in from the installment contract to ultimately pay the dealership back. It doesn't work for two reasons. Number one, you need the cash back over in the dealership to buy more vehicles and to keep going. So the reality when you work with this, it's not about the cash flow aspect. It's about getting enough money back over your dealership to keep your business going. So what we look at is, when I go in, I look at what's the cost, what's your average cost in each deal. So in my example, in the simple example that I gave you, you had an $11,000 receivable, and the vehicle was $7,000. So your cost in that deal was $7,000 in that example. So what I'm saying to you is, you ultimately got to get another $7,000 over your dealership to be able to buy the next vehicle, all things being equal. So that's typically how you come up with pricing your portfolio, is to make sure you're sending enough cash over.
I would say, as long as you do it on in an annual basis that it goes to zero, you would probably be okay. So
Yeah.
Because you can manage cash on both sides of the fence.
That's right. And the way you do that, and that's one of the techniques, is you put the overhead over in the company where the cash flow is. So a lot of people say, this thing just doesn't work. I can't pay my bills over in the dealership. Well, that's because you got too much overhead over in the dealership. You need to be putting more over into the finance company where the cash flow is coming in. So it takes some skill to be able to, to balance it. But your accountant should be able to figure that out.
My situation, by getting back into it, is the selling company has two owners, so to speak, and the related finance company would have three owners.
Mm-hmm.
Because I'm only going to take a 10% thing, but I'm just doing it to keep in the business.
Sure.
But is that a problem under the tax code of not having a relationship in both entities? And even though I am acting as their CFO, so I took that position. So
that's a great question, and you'll see when we hand out, if we haven't already, RJ handed that 26-point checklist out. You did, okay. You'll see on there that an RFC has to have some employees. It has to have at least one employee. Right. So, but the rest of the employees can be shared employees, so that you don't have to pay duplicate payroll taxes. So you can have what we call a common paymaster, which means that he or she is doing work for both companies, but they're only paid out of one company. And as a result, you would share the overhead with the other company through a reimbursement, but he only has to pay the payroll taxes one time. So that is not a problem, what you said. You can be working for both companies.
What if you did the reverse of that, where you made the related finance company the payroll, like a holding company, the payroll master? Just the reverse of it.
And that's what I recommend, actually. That's exactly what I recommend, because the related finance company is going to have the cash from collecting all the receivables.
Well, that's what you're looking at.
That's right.
So
that you're exactly right.
okay, well, that was the main thing I had. And
Okay.
The cash thing kind of interested
Yeah.
me because I didn't. I just knew the inventory thing always kept you out of the
Yeah.
problem. But you're saying now that 25 million, is that a 25 million annually figure?
Yes, 25 million annually in gross receipts.
Right.
In gross receipts. But again, it depends on whether or not your receivables fit into that 120-day test. And
Well,
usually, if it's contracts in transit, you would.
Yeah, 30 to 45 days at the most. So,
Yeah. So it's a limited benefit for us, but it's better than nothing, and it may be a good thing for some of you to take a look at. But just make sure you've considered everything before you do it. Other questions that we might have? Yes, sir, and then I'll come back to you, ma'am.
Question. So in Texas, do you have to have the dealer's license, or is it just the OCC?
Great question, and it's different for every state, by the way. But in Texas, you have to do two things. You have to file the register of the company with the OCCC, but you have to do it for a different reason, and that is because you want deferred sales tax on that, so that you don't have to pay the sales tax up front. You can pay it as you collect it. So that's the big reason why you need to get a seller finance license from OCCC. That's not the case in many states. Some states are more rigorous than others. Some of the states up in the Northeast, they actually treat them like banks, but you're not a bank. You're a company that's buying paper in the secondary market. You're not originating loans to the public, which is totally different. So that's another structural point, that when you set up your related finance company, you have to set it up with it not being a direct lender to the public, just buying paper. So that's the answer. Yes, OCCC, and it's very easy to do. Takes a little time, particularly around the holidays, because they normally go out on holidays about October 1st, I think. So.
And one last question.
Sure.
Collections. Obviously, ownership would be the same for both. Mm-hmm. How does that affect collections? Are there any hiccups with that?
Great question. First of all, in your software system, you just set up a code or a separate entity for the related finance company, but you use the same software system. And so when people are making payments on the contracts, you'll set up a bank account for the related finance company. You use the same software, and you'll make all those deposits. So you'll actually be keeping the receivable records over in the finance company the same way that you would over in the dealership, but you don't have to get new software for it, because I've worked with all the software companies. They all have the ability to sell the contract over and to keep track of it. So it's just keep using a different pocket.
What about the employees both? I don't know if there's like a gray line on who's allowed to actually make the collection.
No, they can be shared. You can have shared employees. That kind of runs to the question that Charles asked there. Yes, sir. Yeah. No, that's all right. Yes, question here.
I just want to verify, in one of the other sessions, they alluded that some dealers are having an issue with substantiating their discounts they're taking because their bids, the companies they received the bids from, didn't really have the intent to purchase. Mm-hmm. So what do you suggest at this point, years down the line, that we do mm-hmm. to help substantiate our numbers?
That's a great question, and I've never had that problem, because as I put in writing in my audio-video product, you should get a third party who actually buys contracts to look at your portfolio and give you a written offer on it. You don't have to do that every year. You only have to do that when your business model changes. And so when the IRS comes in, they go, wait a minute, I think your discount should have only been 10%, and I see you're using 40%. So I think I'm going to say that you're going to be penalized for over-deducting by 30%. That's what they might say. And then you whip out this piece of paper and say, well, I got this offer on my portfolio from somebody who buys contracts. It says 60% is all they're going to pay, And so I think this is more valid than what your opinion is. And it just blows them away. Because what your portfolio is worth is exactly what a used car is worth, what somebody will pay for it. It's not a matter of opinion, it's a matter of fact. So the reality is if you were getting an opinion from a Car Financial or a Mid-Atlantic, I've worked with all these guys and I've arranged it, they'll do it for free. I don't care. They'll give you a free evaluation and a written thing. That's what you should do. But you don't have to do it every year. You just have to do it, one time unless you change your business model. So you used, yeah, yes, 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 yes. Yes. And let me tell you why. Let me tell you why that is, and thanks for bringing that up, Charles. He's talking about my Subprime Analytics. Years ago, I had, when I had NIADA, the automotive technical director for the IRS was a speaker at our show several times. Terry Harris, Bob Zweers before Terry. So I knew them very well. At one time, we were on opposite sides of the fence, but now we're friends. And the reality is that she was well aware of my Subprime Analytics, and she told me we will accept that as empirical evidence to support what a portfolio is worth. We can't argue with your losses. And I just had a case where the fines were $10 million, buy your pay your dealer, $10 million that they were alleging based on discount. And we did Subprime Analytics, and we won it all. They didn't pay anything. The IRS was alleging that they went on the internet and used the benchmarks that I published on the internet and said, well, wait a minute, you're using a discount greater than what it appears would be appropriate with the benchmarks, so you got to be wrong. Well, they didn't even call me or talk to me. They don't even know what they're talking about. They don't even know what the numbers were. So we showed in this case that their losses were greater than that and that it was justified to use it. And that's what you're talking about, Charlie. Yeah, that's right. So, yes, I mean, you need support you need metrics anyway because we've got this new credit loss measurement standard coming. So it's good to have it, but that, you should have both. You can get an outside opinion and you can also use the metrics to support what you're doing. Any other questions here before we break up? Let's see. Well, yes, go ahead, sir. One more.
We have a line of credit that's about to become active. Right after we pull each other back inside.
Good.
When starting the related finance company, our line of credit's only to cover $150,000. We got about $1 million in notes.
Okay.
How do we start getting everything transferred?
Okay, another good question. Again, you don't have to sell all your contracts at one time. What a lot of people do to get started, they sell a block of them because they have enough cash, and then they wait for the cash to accumulate from the revenue off those contracts that they sell, ultimately building up enough cash flow to buy some more. Again, you have to look at what your tax deduction is going to be. You have to look at how much cash you need over in the dealership. There's a lot of considerations there. You've got to price it properly. And then when you do, that gives you the answer. But it's not an all or nothing thing, is what I'm saying. You can kind of pick your spots. Well, I see we're out of time, and I just want to thank you all for staying with me here at the end. Thank you for coming in. Thank you for letting me participate in NIADA. I'm here to help you, and I want to see you do the right things, and I don't want to see you overpay your taxes. So if you have any questions after this session, please don't hesitate to call me. Happy to answer it, or have your call me. If he has questions, I'll be happy to do that as well. And I want you to succeed. God bless all of you, and thank you very much for your time today. Thank you.